Here again with Smart System. In last lesson, we began our discussion on the components which make up the US economy and how each of these relate to trading, with a look at the natural resources and labor force components of the US economy. In today's lesson, we're going to further this discussion with a look at the government and private sector components and how each of these relate to trading. So let's get started. While having lots of natural resources and a large, well-educated labor force to produce goods and services from those natural resources is a great thing. Without a way to organize these first two components of the economy, not much would get done. This is where the small, medium and large businesses, which make up the private sector, come. In addition to organizing the labor force to produce goods and services, the private sector is also responsible for raising the capital necessary to bring all these things together. They do this through private investors, commercial banks and the capital market, such as the bond and stock market. While many people think that the US economy is dominated by large corporations, it may come as a surprise the large role that small businesses play in the US economy. According to the Department of State, of the nearly 26 million firms in the United States, most are very small. 97.5% have fewer than 20 employees. Yet cumulatively, these firms account for half of our non-farm or non-agriculture real gross domestic product, which basically means they account for half of the output of the economy, not including agriculture, and they've generated 60 to 80% of the net new jobs over the past decade. So you can see there that the small business plays a very important role in the US economy. We'll get into more details about the private sector and how all this relates to trading, and later lessons. It should be obvious at this point the large effect that the private sector has on all markets, as they are the ones who, number one, raise capital through bonds and stocks that we then trade, number two, produce goods and services which drive demand for the commodities that we trade, and then number three, affect the foreign exchange markets that we trade by playing a role in what goods and services are produced domestically, which we import from overseas, as well as cross-border mergers and acquisitions, all things which affect the value of the US dollar, whatever currency it is that we are trading. So we're going to get into more details of exactly how all these things move the markets and how we can actually place trades based on that. But you should have a good overview thereof how the private sector can influence the market. The fourth component that I'm going to discuss here is the role that government plays in the US economy. There's several important roles that government plays here, which can drastically affect the markets. One of the most important of which is that of regulator. There are many parts of the US economy that the government regulates, with some of the more prominent areas being antitrust laws, or laws that are in place to protect the consumer from businesses that grow so large that there are no other businesses that can compete, basically allowing those businesses to set unfair prices due to lack of free market competition. If you followed the markets over the last several years, Microsoft has had some issues with this, becoming too big, and the government becoming worried that there might be unfair competition there. Google recently, with their purchase of DoubleClick, there were some antitrust issues there that they had to work out to get that deal approved. So this plays a prominent role in the markets as well here. Also environmental rules. To protect the environment, they set caps on how much a company is allowed to pollute, and then has through agencies such as the environmental protection agencies come in to check those things. And then also, and perhaps most importantly for us, they regulate the capital markets through agencies such as the Securities Exchange Commission and the Commodities Futures Trading Commission, the SEC and the CFTC. The primary way in which the role that government plays in the regulation of the economy affects us as traders is through how increases in regulation and decreases in regulation are taken by the market. In general, anything that makes it easier to do business, which normally means less regulation, is going to be seen as a positive for the market, and the market's going to rally on that. Anything that is seen as potentially making it harder to do business, which is normally associated with more regulation, is going to be negative for the economy in general, and going to cause markets to sell off. So anytime there's talk of more government regulation or more government intervention, normally that is looked at as a bad thing. That's our lesson for today. And next lesson, we're going to continue our discussion on the role that government plays in the economy and how this relates to trading, with a discussion on fiscal policy and how government spending and taxes affect the market. So I hope to see you in that lesson. As always, if you have any questions or comments, please feel free to leave them in the comment section. And good luck with your trading. Have a great day.